to see it.
So you have called this sort of an artificial stimulation of the economy, right? Does this mean that we might see a hawkish pause next week? That's what your former colleague Clarida seems to think.
I agree with Richard Clarida. We'll see a pause next week. However, the economy is resilient heavily because of fiscal spending. Unspent American Rescue Act funds, the Inflation Reduction Act, the Infrastructure Act. And because of that, the Fed is going to need to leave its options open and guard against a reacceleration of inflation or just inflation being sticky.
And it doesn't help that oil prices continue to surge.
And that's right. And the second big issue is oil prices. We've got two policy issues that are affecting this, structural issues. One, we talked about fiscal policy is very aggressive. And the second is our energy transition policy, a feature of it is limiting fossil fuel production in the United States. But the problem with that is we have an undersupply globally. And so I think we're very vulnerable to price spikes in oil. If we produce more fossil fuels in the United States, we're the cleanest producer in the world, we actually might mitigate that. But the Fed has to contend with it. And oil prices feed through everything in terms of goods and services. And so if you have higher oil prices, it means inflation is likely to be stickier.
And we're also seeing some idiosyncratic risks to the economy, right? I mean, we are facing potential strikes and walkouts against the Detroit car makers. This chart on the Bloomberg just showing how this year has been pretty outstanding in terms of work stoppages. Are there any broader ramifications that the Fed needs to consider?
Well, you've got a tight labor market. And again, the government spending on manufacturing projects and infrastructure projects increase demand for labor. And so labor's in a very good negotiating position. And when they're in a good negotiating position and inflation has made it harder for workers to make ends meet, you're going to see more of this kind of labor action.
Yeah, Robert, you've talked a lot to us about, this X factor, right? How restrictive is policy at the moment? How do you kind of even gauge that? And do you think it's restrictive enough? If not, how much more do you see needing to be done? So
the best way I can talk about it is I like to use, not surprisingly, the Dallas Trim Mean, which is running a little above 4%. And so let's say that's a good estimate of inflation. The Fed funds rate's 5.25 to 5.5. So I would say rates are 125, 150 basis points above the inflation rate. And I would have said the neutral rate is something like 0.5 to 0.75. So we're restrictive, not that restrictive. If inflation starts to come down, we'll be more restrictive at this rate. But the issue again is you've got some cross currents and distortions to some extent because of the amount of this government spending. And so I think we're gonna see inflation will soften down to say 3.5, but I think we're gonna find it very entrenched and sticky and hard to get below 3.5.
Is the wage price spiral also entrenched and sticky?
It's the fact we've got a very tight labor market, we've got higher oil prices, we've got government spending that is offsetting to some extent monetary policy, and workers who make $50,000 and less are struggling to make ends meet. So yeah, I do believe we have a bit of a wage price spiral, particularly for those workers that make $50,000 or less, and that's 50 million workers, and they need higher wages to make ends meet.